Hello and welcome back to our channel. Today, we are going to discuss one of the most significant events in the financial history of the United States, the Silicon Valley Bank collapse. In this video, we will look at the reasons behind the bank's collapse and its impact on the financial system. Silicon Valley Bank was a California-based bank that catered to the technology sector. It was founded in 1983 and had become a prominent player in the industry, providing loans and other financial services to technology companies. However, in the early 2000s, the bank began to face financial difficulties, which eventually led to its collapse. Silicon Valley Bank was the 16th largest bank in the US. At the time of its failure, it had $209 billion US in total assets, the U.S. Federal Deposit Insurance Corporation said. As one might expect from its name, the bank catered to firms in the technology sector, as well as the healthcare sector. One of the primary reasons for the bank's collapse was its exposure to the dot-com bubble. In the late 1990s, there was a massive surge in technology stocks, which led to a lot of speculation and investment in the sector. Silicon Valley Bank was one of the banks that financed many of these companies, and when the bubble burst, it led to significant losses for the bank. Many Indian tech startups had taken loans from Silicon Valley Bank, and when the bank collapsed, these loans became due. This created a significant financial burden on the Indian startups, which were already struggling to compete in the global tech industry. Many startups had to cut back on operations, lay off employees, and even shut down altogether due to their inability to repay their loans. One of the key factors that contributed to the bank's collapse was the valuation of its assets. The bank's assets were primarily made up of loans to technology companies. However, as we now know, many of these companies were overvalued, and their eventual failure led to significant losses for the bank. Another issue was the lack of diversification in the bank's assets. As we mentioned earlier, the bank had a small number of big-name clients, and its assets were heavily concentrated in the technology sector. This lack of diversification made the bank particularly vulnerable to downturns in the tech industry. The bank's valuation also played a role in its eventual collapse. The bank was valued based on its future potential, but as we now know, this potential was overstated. The bank's management team and investors believed that the bank's assets would continue to appreciate, leading to further growth and profitability. However, this proved to be an unrealistic assumption, and when the tech industry experienced a downturn, the bank's assets declined in value, leading to significant losses. The collapse of Silicon Valley Bank had a significant impact on the financial system in the United States. Many of the bank's clients were technology startups, and their failure led to a wave of bankruptcies in the sector. This, in turn, led to a broader economic slowdown, as the technology sector was a crucial driver of the U.S. economy. The collapse of Silicon Valley Bank also led to increased scrutiny of the banking industry in the United States. Regulators began to take a closer look at the practices of banks that cater to specific industries, and there was a renewed focus on the need for sound banking practices and risk management. In conclusion, the collapse of Silicon Valley Bank was a significant event in the financial history of the United States. It highlighted the risks of over-reliance on a few large clients and the dangers of exposure to speculative bubbles. It also led to a renewed focus on sound banking practices and risk management in the industry. We hope you found this video informative. Thank you for watching.